Good afternoon, and thank you for taking time away from your families and businesses during this challenging time to join us for this Epic Insight. This is Brian Lenz, Director of Sales and Strategic Partnerships here at Epic Retirement Plan Services, and I'll be your host for today's call. Today, we're fortunate to be joined by Dave Lukuski of Stadian Money Management to offer their perspectives on technology, participant behavior, target date funds, and managed accounts as they relate to the retirement plan industry. Dave is a Senior Vice President and Chief Distribution Officer and is responsible for distribution of Stadian's retail and retirement investment products. Dave joined the firm in 2013 as Director of Retail Distribution, and in 2016 has assumed leadership over distribution of all of Stadian's products in all lines. As a 20-year veteran of the industry, Dave has both leadership and hands-on experience in all aspects of financial intermediary distribution, inclusive of sales, relationship management, and marketing. And we're excited to learn from Dave's extensive experience today in an increasingly complex environment that is the retirement plan world. Couple of quick items. Your line will be muted throughout the call, but if you have any questions, feel free to serve those up in the questions panel in GoToWebinar there, and I will run those by Dave at the conclusion. And also, if you were intending to seek CE credit but neglected to enter those details when you registered, please make sure to email marketing@epicrps.com with your information and desired credits, and we'll get that taken care of for you. With that, I'll turn it over to Dave.
Thanks, Brian, and thanks everybody for joining us here today. I'm reaching out to you from my COVID-19 bunker, which fortunately is in Key Largo. We kind of secured a place here long ago, and it's not all that big and nice, but it's by the water and a welcome change of pace, given some of the challenges that we're all faced with. But despite the environment and even being in Key Largo, it's really interesting. I can tell you downstairs and upstairs I have family. My wife is working remotely. My children are doing Zoom school, and I have one daughter even continuing her music lessons. So it's really interesting how technology has evolved, but more importantly, we're all put in a position where we're using it. And what I'll say about technology is it's fantastic, but if it does not get utilized, it really serves no purpose. I think that's a good tie-in or transition to our conversation today, because what we're going to talk about really is how technology has evolved to the point where we can start to introduce some basic tenets of financial planning into the DC space to serve those plan participants. To get you in the right mindset, I'll ask you to really think about your book of business, and you probably have a wealth management client base, and you probably have retirement plans, which is why you're joining us today. And I'd like you to think about the experiences and the services that you have with those two different demographics or groups of people. The most common element that we see in the wealth management world is there's a lot of discovery that occurs to understand who the investor is, what their needs are, their objectives, the risk tolerance. As a financial advisor, somebody delivering a plan, you also think about the service that you provide, the amount of communication, your client events. And when you compare that to the plan world, you have all your plan participants, and you can probably recognize that there's some differences between the two groups. So this is our Where's Waldo slide. And what we use this slide for is to point out that every group or population of people is nothing more than a bunch of individuals. And every individual has their own perspectives, they have their own objectives, their own needs, and that leads to different types of investment allocations and why the concept of financial planning is so important. We're going to talk about a few things in the CE today. The first is the evolution of the 401k industry. kind of how we got to where we are from a investment perspective. We're going to look into technology and participant behavior. Actually, strike out the word participant. That section really focuses on consumerism, how technology has improved our lives, and really the expectations that consumers have when working with different service providers and retail solutions. We're going to dig into the target date fund world from a construction standpoint. The material we're going to share with you comes directly from Stadium's research that we use to develop and provide our own asset allocation solutions. Many advisors find that to be incredibly interesting. And then we're going to talk about the evolution of managed accounts, how they're now using technology to gather information about plan participants and their ability to deliver a personalized experience for those participants, which means personalized allocations. As a reminder, this is a CE course. We're able to deliver the CE via this WebEx technology today because of the timestamps. If you're requiring CE, if that's the expectation, we just ask for you to stay on for the duration of the call. If we don't have the proper timestamps, we simply won't be able to provide the CE, and our goal is not to disappoint anybody. So thanks for your attention today. Brian, thanks for the very kind introduction. If you were to read that, you would just find out that my golf game is not very good, and I like it anyway. And of course, enjoy spending time with the family and being down in Key Largo fishing. So let's kind of dig into the meat of the presentation today, which is really about the differences between the plan space. The most commonly used investment option out there is the target date fund, and how that compares and contrasts from a financial planning perspective. I think target date funds are fantastic. They've provided a world of good for participants, and they also are a mechanism that helps us to reduce risk as the participant gets closer to retirement age. Financial planning, of course, does some similar things, but really requires a lot more investigation into who the investor is so that we can deliver what would be considered a suitable portfolio. In its most basic element, there's more data, more information that needs to be gathered before a solution can be provided. As a matter of fact, in your wealth management business, I'm pretty certain there's not a principal or compliance officer in the world that would sign off on an allocation if the single data point you had on the investor was their estimated retirement age. Let's take a look at how we got to where we are today. Every CE presentation, every good one at least, has a couple slides that you already know, and this is no exception. What you're looking at here is the demise of the defined benefit plan and the rise of the defined contribution plans. And we all know the reasons for this. A lot of it is the difficulties administering defined benefit plans and the costs associated with them. It was just much easier on companies to provide a defined contribution plan, which meant that the participant was being given the responsibility to be retirement ready. I also look at a slide like this and it spells opportunity. When you have this much divergence and a positive trend of a solution, I'm certain many of you took advantage of that opportunity and grew your business through the growth of DC plans. The ecosystem of a 401k plan is relatively complex. At the top of the pyramid here is the participant. They're the reason we do what we do. The reason the plan sponsor offers the plan to provide that benefit to its employees. Your role sits squarely in the middle. You allow the plan sponsor to do what he'd prefer to do, which is run his small business and not get so consumed with all the different parties, all the different services, all the different fiduciary roles, so that you as an advisor can go present a good quality plan design concept, put all the pieces together, and allow that plan sponsor to do what he wants to do, which is run his business. Won't get involved too much here, except simply to point out managed accounts on the bottom right. Managed accounts is just an investment service. The service is offered by a fiduciary who's responsible for acting in the best interest of those plan participants. We talked a little bit about target date funds already. They first were brought to us in 1994, and there was some critical legislation, the Pension Protection Act, which really helped propel target date funds into the success that they're enjoying today. The Pension Protection Act was a really thoughtful law. There was a gentleman, Richard Thaler, who won a Nobel Prize in behavioral economics. And through his research, he basically identified that groups or crowds of people, when given a choice, will choose to do nothing. 2/3 of all folks given a choice will choose nothing at all. And that really kind of was a challenge for our industry. When we gave a lineup or investments and asked participants to choose, many just didn't. So the Pension Protection Act provided us the QDIA and safe harbor protection, which meant that we could safely, without fear of legal ramifications, introduce participants into diversified equity solutions, which would benefit them over long periods of time. So fantastic ruling, and it's done a lot of good. Today, when you look at the difference from 2006 moving forward, and you think about evolution or innovation in the investment world, there really hasn't been too much. I know there's a lot of individual advisors that build their own investment solutions or allocations. You have custom target date funds and managed accounts. I think by the time you wrap up today, you'll get a good understanding of some of the innovation that has taken place in the managed account landscape, how they're using technology to introduce some of the basic principles of financial planning to the plan participants. Another good slide of content you already know. First off, QDIA requirements. There's some things you can't do. There's penalties or restrictions on using other plan investments. So you can't just default people. There has to be another choice. And of course, employer securities, putting company stock as an example and forcing people to invest in that is problematic. The ruling also gave us investment products which met the definition of QDIA. I think you're fairly familiar with the first two and even the third. Balance funds or a risk-based fund, target date funds, and managed accounts all meet the definition of QDIA, which means they can be used as a default. I find this slide to be pretty interesting. If you go back to 2006 when PPA was passed and you look at the success of both target date funds really accumulating, now north of $2 trillion in assets, attracting approximately 85% of all new plan contributions, very successful. And when you look at the risk-based funds or the balance fund, it really kind of leveled off and started to demise. And I ask myself, why is that? Why are these diversified allocations so starkly different from their asset gathering capability? And I think it came down to a really simple answer. When I said, what does the target date fund do that the risk-based fund doesn't do? There was essentially one answer. The target date fund de-risks or has vintages that reduces equity exposure as the participants get closer to their retirement age. It'd be pretty challenging for somebody to lose 30, 40% of their wealth when they were close to retirement. So on that single factor alone, estimated retirement age really propelled target date funds to great success. When you look at professional management, this is a spectrum of the evolution, and you'll see here target date funds and the custom target date funds. You'll also see risk-based models, and over to the right, you see the managed account. What separates the managed account from everything on the left is its structure itself. You see, what's not listed in the description of managed account is the word fund. Managed accounts are not a fund. It is not a product that issues shares of a common investment and treats all shareholders alike. Managed accounts in the retirement world is a service, and the structure of them allows us to build unique and individual portfolios for the individual plan participant. So starkly different One, a fund is a product. The managed account is a service offered by a participant fiduciary. So let's kind of wrap up and summarize. What we learned is the Pension Protection Act and Target Date Fund have done wonderful things for investors. They still do. They're enjoying great success. And that single factor, age, allows us to start to introduce a concept of financial planning, a de-risking. But we also recognize that financial planning, real financial planning, requires us to gather much more information about investors to provide more appropriate allocations. The Pension Protection Act was great. It provided QDIA and safe harbor protection, which really allowed participants to be defaulted into a diversified blend of equities that would benefit them as they invested throughout their working years, 10, 20, 30 years. As we go into the next section, I'll just let you know right up front, this is my favorite slide, and it probably shows my age a little bit. My mom, Saturday mornings, we would get up and it was chore day. If we wanted to get outside, play football with my buddies, ride bikes in the neighborhood, we had to get our chores done. The first thing that happened in the morning is my mom got up and put the records on. She was a big fan of Engelbert Humperdinck and Kenny Rogers. Still have those songs going through my head today. And I remember listening to this music and vacuuming the green shag carpet, which was very fashionable back in the day. And I think about all the work that went into that experience, not work by me, work by my mom. To be able to provide music, she had to go to the store, buy the records. She had to pull them out of the sleeve, put them on the record player, drop the needle. If she wanted to change songs, she had to go over there, change the needle, take the record off, put it back in the sleeve, pull the new one out. Point being is today it's a very different experience. And that experience dramatically improved because of technology. Today, at a touch of a finger, you don't need to buy any additional equipment. You don't even need to build your own playlist. You listen to songs, you hit like, and over time, the technology learns your habits and will create a playlist for you. So just a good example of how technology improves many facets of our lives. Consumerism is also interesting. Starbucks has made a great business on personalization. Yes, they have fantastic quality, but they also personalize everything to their consumer. I have somebody in my family that likes that really extra long order, macchiato, extra foam, soy milk, extra with a caramel drizzle. It just gets really long, but the point is you're able to get exactly what you want. And when you think about our world, when you think about the plan participants, we really haven't seen much in the way of evolution in the 401k space when it comes to investments. And this is a consumer stat. It's not a 401k statistic. It's from market consumerism. 80% of consumers are more likely to do business with a company if it offers a more personalized experience. And I think that's probably the macro positioning for managed accounts. As we talked about earlier, managed accounts are enjoying a structure that allows a participant fiduciary to build an individual allocation at the participant level. This is a slide we can get through relatively quickly because this is a world that you all live in as financial advisors. You know the importance of what you provide. Everybody on the phone believes in the basic consumption of advice, helping to deliver better outcomes or results. Yet there's too few people that seek that advice. Many get help changing their oil, plumbing, landscaping, doing taxes, but only 24% of 401k participants actually get help allocating their dollars. Surveys from the industry experts will say that 71% of plan participants are seeking that advice. So what's the disconnect there? And it's a pretty wide gap. In order to give a participant real advice and to tell them what to own and to change the allocation, it means that you're acting in a fiduciary capacity. Many advisors would prefer not to do that and therefore stay solely focused on education. One of the nice things about managed accounts is it can assume that advice engine for you and deliver the advice that apparently is needed when participants are surveyed. Do participants need the help? I think is another great question. These slides would suggest they do. 54% don't know how much to save, 64% are overwhelmed, and probably the most startling one is 30% don't know their employers offer a retirement savings plan, which is really a shame because that retirement savings plan is really the source of free money through many of the matching provisions that are offered in plans today, or at least the quickest and biggest return that anybody will probably get in their lifetime. We also have practical experiences, and I'm certain you and your work with participants and plans have your own stories. This one comes from an advisor who did a fantastic job at an education meeting. Afterwards, he clearly explained the plan, the lineup, the target date fund option in the plan. But a participant said, I really like that target fund you were talking about, but I'm just not a big fan of Target. You see, there's a Walmart in my town. They take care of the community. Everybody shops at Walmart. Do you have a Walmart fund that I can invest in? So I think what it kind of shows there is education is incredibly important. It's encouraged, but unless the participants truly understand, and more importantly, then go and take action, there can be that gap between education really helping benefit the individual participants. So let's summarize that section. And what we'll notice is technology is fantastic. We're using it today to deliver CE via web service. It improves our lives. It gives us better product solutions, and also consumers are expecting it. It's just what we see. Recently, I turned on TV, and now you can buy socks to your shoe size. You don't have to buy that size 6 to size 13. One size fits all approach. And it'll be really interesting to see how innovation really evolves in the 401k space going forward. I think this section is pretty eye-opening for many. It talks about the target date fund industry, and as I mentioned, we'll review some of the research that Stadion has performed when we've developed our own solutions for our managed account service. We'll review the target date fund basics. They're simply offered by an asset manager or the manufacturer of the target date fund. The manufacturer will introduce the different ages or vintages. That's the 2020, 2030, 2040 fund. And then, of course, the series is the collection of those things or the product solution that's delivered and put inside the plan. And I think the one thing that's really important to understand is there's no standard uniform way of doing things. There's no Morningstar style box that kind of defines what a large cap fund is, and parameters to follow or be kicked out of the box or the category. Target date fund manufacturers often do things their own way, and I'm certain there's best intentions, but what it leads to is a lack of uniformity around the solutions. As an example of that, you have some manufacturers that provide target date funds with 5 and 10 year increments. Some may go through, have a post-retirement solution or an income fund, just as an example. And there's also really important elements of target date funds that are different, but are easy to understand. What's it constructed of? Is it a mutual fund? Is it CITs? Is it offered by an insurance company? Are they using a VIT structure? What's the management approach? Is it an active strategy, a passive strategy, or a blend of both? And then, of course, you have the underlying securities within that fund. What we put over here on the due diligence column, and I'll focus on the first point, is the glide paths. The glide path sets the macro allocation between equities and fixed income, which really largely determines the amount of risk or exposure that those participants have to the market at any given time. And what we'll point out to you is there's no uniformity of glide paths. There's no standard way of doing things. What this slide shows you is a glide path. It's actually the S&P Target Date Index, and I think S&P was confronted with the same challenge. They're very interested in obviously providing indexes to help us compare and contrast investments to, but when it came to the target date fund world, they were so ununiform, no standardization, that the methodology that they created was a survey. They reach out to all target date fund providers and they learn about how they do things. They learn about their glide path, their macro allocations, the underlying securities, and from that survey, they're able to come up with an average or a median to create the index with. This is how most target date fund companies do things. And with that as a backdrop, you can then start to compare the target date fund you're using to the index, or some people would refer to this as a benchmark. Does the glide path carry more risk or less risk than that index? And here's why it's important. This is what our research found, is that it's as clear as mud. When you look at the different glide paths that are out there, the variance of equity exposure is pretty dynamic. And there's a lot of them. So what you're looking at here is glide paths that range from very little equity exposure to a lot of equity exposure. And you'll notice here historical in the sense that some of these glide paths don't even exist because they just didn't stand the test of time. Either they were too conservative, too aggressive, and their advisors are always looking to kind of do some screening to kind of come up with things that you all believe in, like what type of glide paths follow the basic elements of strategic asset allocation, for example. So what we wanted to do is we wanted to kind of filter down this universe similar to what you would do and come up with a workable glide path universe to compare and contrast glide paths, as well as to create our own glide paths for our solutions. So here's the narrowing down process. We identify all the glide paths out there, similar to what we just showed you. We filter those down. We eliminate the very small, low AUM strategies, get rid of the non-traditional paths, things that don't follow the basic tenets of strategic asset allocation. And we were able to narrow it down and come up with a glide path universe, a digestible group of glide paths that we can kind of compare and contrast. Walk you through a little bit of the process. When we surveyed, or when we went out there and we identified all the different manufacturers, what we noticed was some manufacturers had many different target date fund solutions. So for example, Fidelity has 10, T. Rowe Price has 5. So we started saying, do these manufacturers, do those 10 or 5 solutions, do they all have different glide paths? And the research was pretty startling. The research said, though there was 10 different solutions, all 10 of those solutions follow the same exact glide path, or they all have the same macro exposure to equity. T. Rowe Price, same thing. You'll notice there are some companies that have like a single path, or are here twice, which means they would offer multiple glide paths for you to choose from. We then filtered it down. We started to reduce some of those low AUM esoteric solutions, and we ended up with a workable universe of 57 unique glide paths. And here's what it looks like. We were happy to see the conclusion of the filtering process because we captured 97% of all target date fund AUM. And we felt that was really important because AUM often comes from your suggestions. So it was really nice to see that our process and what you're suggesting aligned. There's 57 glide paths that meet that criteria and were defined in this spectrum that we call the glide path universe. Despite the narrowing down process, I think it's really important to also understand that there's still a wide variance within these different paths. So for example, if you look at risk, which is the amount of equity exposure on the y-axis, time, retirement age 65, and you go to 10 to 15 years before retirement, I think those are pretty crucial years. What you notice is, depending on the individual glide path or target date fund that you select for the plan and for the participants, the amount of equity exposure can range as little as 43, 44% to as much as 83, 84%. A huge difference in the amount of equity exposure or risk, which of course leads to different outcomes and results. And I also find it very challenging for you all and for plan sponsors, because how do you select a single glide path that's going to be appropriate at the plan, but also appropriate for all the individual participants within those plans that may have their own unique needs and circumstances? We talked about glide paths and the macro allocation to equities being perhaps one of the biggest driver of investment results. And this kind of validates that. What you'll see is 2019 performance. We replaced the y-axis from equity exposure to return for the calendar year 2019, and these would be all the different vintages of the target date funds. So if we go to that area, 2030, 2035, what you'll notice is the investment results vary greatly. Just around 16% to about 27.5% in 2019, which was a fantastic year in the market. The indexes, S&P were up around 30%, and the target date funds all did very differently. And I would perhaps like to offer that if you were down here and you underperformed the index, it doesn't mean it was a bad fund. My suggestion is perhaps the return just aligned with the amount of equity exposure that target date fund used. So it's never a poor fund if the return aligns with the risk objective of the strategy. But it's just interesting because there's probably some participants, some plan sponsors that were criticizing target date funds that maybe didn't carry as much exposure. And maybe they're grateful today, but the point being is there's no right or wrong here. I think what's unfortunate is we're not able to look into the participant level to understand what the participant risk is and then assign a particular glide path or an allocation that meets the objectives and risk tolerance of those individual investors. We find a lot of variance post-retirement. Retirement is zero. Here's your solutions afterwards, and you'll see even post-retirement, there's incredible variances amongst equity exposure. And I think this is a really great lesson for us all because it's something that we're living through right now today. We just experienced one of the worst months ever in history. That month defined a bear market, and participants are now getting those statements from Q1. And if we go back to 2008, the last time we saw a bear market, what you'll notice is the investment returns back then, and then we took the 2010 vintages, varied greatly. And depending on the glide path of a target date fund that was used, there was losses that were only 10, 11%. I think that's digestible for somebody that is at or near retirement, but it's a very different picture when you start to look at losses of 25, 30, 35, 40%. It's a completely different experience, completely different satisfaction level if you're at or near retirement and you lost 30, 40% of your nest egg, which is why it's critically important to understand the risk behind the target date funds. What we've seen in the last 10 years is an incredible bull market, and it's no surprise. I think people recognize this is often how things happen. Funds that perform well get a lot of flows, but what we've seen in the target date fund world is the best performing funds were the funds that had the greatest exposure or the most aggressive glide paths, which probably hurt in the first quarter of this year. Kind of wrap up this point, I'll start by saying if you're ever interested in digging deep into target date fund research, glide paths, allocation, how it compares, reach out to your friends at Epic or give your Stadion retirement consultant a call. We're more than happy to show you our research and allow you to ask questions. We have a pretty robust database and really strong analytic technology that allows us to do our research, and we're happy to partner with you on it. Just know that that service is there if you'd like to. I think the other thing to take away here is target date funds, I think, are relatively simple, which is why they have enjoyed such great success. But we also need to look at the complexities, the nuances of those individual target date funds, understand what's different, mostly focused on the glide path. Again, if you believe that markets are systematic, then we have to pay attention to the glide path and the amount of equity exposure that's there. At a minimum, I think it's incumbent on all of us to understand, is the target date funds that we're using, are they carrying more risk or less risk than that index? And the last point is, it's a big job. Deciphering all the target date fund manufacturers, their way of doing things, and coming up with the most appropriate single line or glide path that's going to meet the needs of the plan and the individual participants. Clearly a challenge. So let's take a look at managed accounts. I'll tell you to start this section, my belief is managed accounts needed to evolve. They needed to innovate. Happy to report that the managed account providers, and Stadion isn't alone in this, is enjoying a lot of advancement and innovation because of technology. We are able to deliver personalization at the participant level only because of technology. Over the last 10 years, we saw data population. People are collecting and disseminating data, and that's essentially what's happening with the managed account providers. They're able to collect participant data, which is the driver of personalization, and solutions like robo-advisory solutions is a discovery process that allows us to use technology to align the appropriate investment allocation with the individual participant. So what we're really showing you, I think, has really come a long way in the last few years. So first, what's the difference between the target date fund and managed accounts? I think really it's a difference between a product and a service. Products are great, they're simple, you put it in a plan, people buy their shares, all investors are treated equally, they're shareholders. Managed accounts are that service, and both the target date fund and the managed account relies on information. In this case, it's estimated retirement age, but this is where it starts to diverge a little bit. Managed accounts allow us to introduce the basic principles of financial planning because we simply have a structure that allows us to gather more information about the participant, and that information is used to influence or change the allocation to align it with the participant needs. It's pretty much the process. Participant data is out there. It can come from a lot of different places. It can come from the plan sponsor. It can come from the record keeper. It can come from the participant themselves. All those data points are given to Stadion or the managed account provider who acts as a participant fiduciary. And just a quick reminder, this is not an investment fiduciary services. There's a difference between the plan lineup fiduciary and the participant fiduciary. We do not act as a 338. We are not in the investment lineup business. All we simply do is seek to understand who the participant is, analyze the data that we receive, and provide a personalized allocation acting in the participant's best interest. Are there demand for managed accounts? There's two statistics on here. One I think is very commonplace, and I think the other people find interesting because you may not necessarily realize that there's been this much adoption. The first is 87% of all plans have a target date fund. I think that's no surprise, especially given the conversations we had about their success. What may be surprising is 59% of all plan sponsors offer a managed account. Yet we don't really see it in the small and mid-market. So who is it that's using all these managed accounts? And the answer is the largest plans in the country. The largest plans offer these services to give the employees more benefits, and they find it really valuable to give that, bridge the gap between the 24% of people that are getting help with allocations and the 71% that want it, based on the statistic that we shared with you earlier. In our industry, we always talk about the value of outcomes. And I think it's really easy to understand the benefit and managed accounts because we're all essentially in the same business. We all believe in the value of advice. And I think the third column supports that cause around advice. When people are given a plan and told what to do and it's in their best interest, there's a higher probability that they stick to the plan versus an investor that is given a wide variety of investments, gets emotional through different market cycles, and perhaps makes a change and gets away from the plan. What we're seeing is retention rates of 74% of managed account users stick with the plan or keep the managed account for 10 years or longer. That contrasts with just 33% for full target date fund users. Based on what we talked about, the value of advice, the value of having a plan and sticking with it, you can see that translated clearly in outcomes. Using a managed account increases wealth by 23%, and that's over a 10-year period of times. So we talked a little bit about the evolution of managed account, and to be critical on managed accounts, I think evolution and innovation was absolutely needed. The fee structure were high. They were often provided by smaller asset managers that didn't have the scale. We've seen price consolidation, and we've also seen more partners come on board. And hats off to Epic. They kind of are interested in having a very competitive product. There's no additional fees or revenue components added to the managed account service. They're not interested in making money on the managed account. They're interested in following their model, which is collecting revenue for the record keeping services. I think what you'll find is that managed accounts today are priced very competitively. You get a personalized service for approximately the same price as an actively managed target date fund. So there's been a lot of evolution in the space when it comes to fees. And we also talked about participant data and technology. It was really hard to get participant data and to get participants to engage without technology. And if you couldn't get the data, it really didn't produce personalized solutions. So the conclusion was, why use the managed account? And I agree with that. However, what we've seen is the technology changes. Participants now can grab their phone. In less time it takes to drink a cup of coffee, they can sign up for a managed account service, and that data transfer begins, and you can deliver these personalized allocations in a very scalable and efficient way that were really just not done even just 5 years ago. So I think those were some of the big changes. Other objections, we touched on fees and the digital platform, making this scalable. And I'll maybe offer this to you as a simple solution. Managed accounts today, through you, we only sell through advisors. We do not have any direct business. Basically introduce a robo-advisory service for the plan participants. Vanguard does this very inexpensively, and it's that kind of a platform that helps us to deliver these managed accounts at a reasonable fee structure. And you also play a big role. Remember, your role is to deliver a high quality plan design and work with all the different service providers that are out there. We're just another service provider delivering that personalized element to the participants. And your role, which is squarely, in most cases, education, because most broker dealers and even RIAs and advisors themselves, they just do not want to become a participant fiduciary. Have those processes in place, the paperwork involved in it, as well as the legal ramifications of accepting that responsibility. As an educator, when you add more services and more fiduciary services to the plan, there's more for you to educate on. And it also can get you out of a tight spot. I think we've all been in a situation where you get done with an education meeting and the participant just really wants you to tell them what to do. The minute you do that, you just accepted the role as a participant fiduciary. Instead, you can say, it sounds like the managed account service may be right for you. Let me remind you what it is again. You can just grab your phone and they'll literally create the allocation for you. So it's a really nice complementary service that you can offer to the participants and the plan sponsors. What's next for managed accounts? I think you're going to continue to see technology evolve. I know at Stadion, and Brian and I were talking earlier, there's going to be more opportunities for the advisor to play a role in the managed account. One of the capabilities that we will have in the very near future is something that we refer to as funds and plan. Today, you may either create a lineup or hire a 338, and you think about all the work that's done in the due diligence of creating that lineup and monitoring of that lineup and giving it to the plan sponsor, yet 85% of all the contributions go to a target date fund. They're not even using the diversified investment lineup that you provided. The money is going to a single manager target date fund. So what we're able to do is we can take your lineup, we can build a custom QDIA as well as the personalized participant allocations with the funds in the plan, the funds that you either recommended or hired a 338 to provide. So advisors really like that because it creates some synergy in what you're doing and what the participants are actually investing in, and there's a lot of work that's done around that. The other thing that you'll see is some advisors will want to have a fiduciary role, meaning they're going to really create the allocations, do security selections, and even do participant assignment. Essentially, we can give them the keys to our car, give them our technology, and then all of a sudden they're delivering the managed account. Just know if anybody's willing to take on that type of functionality, they then become a participant fiduciary, and they'll be signing a fiduciary agreement between Stadion and the plan sponsor. Not preferred by most. It is a function. Most are very happy to give us their lineup that's inside the plan, and we can build the custom QDIA and the personalized allocations without the advisor being a participant fiduciary. The other thing is with the increase in technology is increase in data. Because we're able to get data from plan sponsors and record keepers, we can start to personalize even at the default level. So one of the knocks on managed accounts was you had to get the participant engaged to get that information. We can now take the data we do get, personalize the allocation with that data, and then give the participant a much easier lift where they can just tell us what the outside assets are, take the risk assessment. But standalone, if given enough information, we can do things like income replacement ratio and adjust for cost of living as well. So we'll summarize here. Financial planning is incredibly important and the value of advice is there. What we're seeing is technology is allowing managed accounts to deliver a more thoughtful experience similar to the financial process. What we're trying to replicate what you're doing somewhat in your wealth management practice. We've seen fees come down, we saw technology improve, making today's managed account a pretty unique and compelling solution. And experts would expect that managed account utilization increase over the next few years as a result. We're going to summarize today and try to give you guys enough time to ask any questions. But I think the most important things here is target date funds continue to be a fantastic and very simple solution. We do recognize that technology and innovation improves things. We're starting to see the managed account providers use technology and innovation to deliver a more personalized approach. And provide different levels of risk tolerance, meaning different types of glide paths. And when it comes to glide paths, we feel it's really important that you as an advisor understand the risk involved with any particular target date fund. Is it more aggressive, more conservative? Again, if you wanted any help with that, please let us know. And I think the last thing to mention is just we are really pleased to partner with a high quality independent record keeper like Epic, great partners, and allowing really, they're embracing what we're doing and embracing the low cost without adding extra fees, making it a really valuable service. So Brian, thank you. We appreciate this opportunity. From a logistics standpoint, Epic will pass us the attendees. We'll see the stamps from a timing standpoint and then deliver an electronic communication with the continuing education. Thank you all. We hope that you found this valuable.
Yeah, thanks, Dave. Appreciate the insight. And I got to say, I am digging the quarantine do you got going on there. Very stylish. We'll open it up to a few minutes of questions. I see some rolling into the panel here now, but if you have anything you want me to run by Dave, feel free to throw that out there. The first one, Dave, is you mentioned the lack of uniformity, not that it's a bad thing in target date funds, but that it creates another layer that needs to be evaluated. Would you say the same applies to managed account services, and what are some of the things in general that advisors should be looking at when deciding A, if it's right, and B, if so, which flavor is the right one for a plan?
Yeah, fantastic question. And the same is true with managed account providers. Managed account providers do things their own way. Some kind of only attempt to solve for income replacement ratio. Others feel the more data you can get is better. I know at Stadion, we're pretty unique in the sense that we have a risk assessment. We believe that understanding an investor's risk tolerance is really critical to get them to stay the course. So I think that's a good example of how a managed account provider can do things differently. And the other thing that we've kind of embraced is we want to be able to talk about how we're doing. I think managed account providers have kind of struggled with that. What we do is we kind of recognize the S&P target date index as a benchmark. And because we seek to identify risk tolerance, we can then have allocations and glide paths that are more aggressive and less aggressive, which allows us to do some benchmarking and even performance reporting. So we're really happy about that. And managed account providers use technology very differently. I think at Stadion, we've completely embraced technology and the transfer of data. So yes, managed account providers don't do things all the same. I think if I'm an advisor out there, I want to understand, if the idea that you're trying to solve for is a financial planning component, I think it's ask the questions. What data points are you getting? And how are you benchmarking your portfolios? I think those are two really good questions to start. And then the last part would be technology. How are you utilizing technology to make this a very easy experience for both the plan sponsor and the participant? I think are good places to start.
Great, thanks. Piggybacking off of that, you addressed this in your commentary, Dave, but historically, one of the rubs with managed accounts is that it's been difficult to engage with participants to extract enough information to provide them a truly custom allocation. And in effect, if you can't do that to some degree, they're kind of getting a target date fund in a different format. You also showed some things that you are gathering now to be able to provide more customization even without participant engagement. I guess two questions, two phases of a question. One is, how much customization are you able to offer just by gathering data? For example, is it all 9 glide paths that hypothetically you have, or is it more like 3 unless a participant actually starts risk profiling with you? And secondarily, what kind of steps are you guys taking to engage participants and actually get some risk preference type information from them?
Sure. I'll go to the second one and then the first question, if that's all right.
Sure.
I
Yeah.
think we recognize that, this is a relatively new concept, and managed accounts are new, but a lot of the innovation and solutions are new. And when you do new things, that requires education and support. Stadion has a national team of retirement consultants that's more than happy to meet with you, have conversations, answer questions. We can do plan sponsor consultations if you'd like us to. We can even be involved in the education enrollment meetings to kind of help people explain what we do. Post sale, we actually have an 800 number for participants to call. So I think you'll see there's a lot of support. Going back to the first question, yes, data is critically important. The fewer data points you get, the less personalized it's going to be. We can build participant allocations with the data we do receive, but we also believe through technology we can simply and easily engage participants. During education and enrollment meetings, we ask them to bring their phones. It literally takes about 3 minutes. The risk assessment is 9 simple questions. We get, they get a plan ID, so some information is already there, and we get outside assets and things like that. So all those come into us, and we're able to utilize that. I think the most important factors data points are income replacement ratios, which are things like salary contribution rates, time left to go. We can make some market assumptions. Also outside assets, how does that play a role? We talked about risk tolerance, and one of the things that we have, our standard offering has 7 different glide paths in it and a different age point all the way across. There's actually over 400 combinations out there. And that data that we collect will really kind of drive where they sit, from conservative to aggressive. And that, if we don't get all of it, we'll do the best we can. So we like to say we can personalize at the default level with just the information that we do get from the plan sponsor and record keeper, and the participants can personalize further doing the risk tolerance questionnaire and things like that. So, and we want to be there. We recognize that the more data we collect, the better the service is. We want to provide a high quality service, and that's why we're happy to be with you every step of the way. We actually have some remarkable statistics. When we get an opportunity to educate the participants, we find our take rates on the managed account are close to 70%. It's pretty remarkable. It aligns with that statistic that people want the advice, and the technology allows us to really kind of differentiate our services and deliver truly personalized portfolios. And, probably a high level answer to the question. We're happy to take that offline and really dig in and even do a tech demo with our PM and product team if somebody would like.
All right, good stuff, Dave. Thank you again, and thanks to Stadion Money Management, and thanks to everyone dialing and watching today. We are pleased to be able to offer Stadion Storyline Managed Account on our platform at the lowest cost it can be in the industry, and look forward to also rolling out those custom options for advisors who want to put their touches on the managed account. As a quick reminder, we will follow up with an email with the slides that you saw today, as well as a link to a recording of the session. And if you did not enter your CE credit information during registration, please again email that to marketing@epicrps.com with your contact information and desired credits, and we'll get that over to Stadion to take care of it for you. We wish you safety and health as you support your families, colleagues, and clients during these times. Hope you enjoy the long weekend coming up, and please don't hesitate to contact us here at Epic RPS if there's anything we can do to support you. Thanks again, all.
Thanks, Brian. Thanks, everybody.